Since the 2018 fall, gold has soared by 70%, $850 to be precise. The current cycle has shown that the Fed's steps to save the real economy are having a positive effect on the stock market. Therefore, Goldman Sachs' prediction of $2,300 per ounce may come true sooner. Welcome to the Coin Post. The gold price has surpassed $2,000 threshold and continues to grow. And while making the video, the rate already exceeded $2,040. And all indicators are that this is not the limit. Meanwhile, the US stock market continues its upward trend, and in the next months we'll be able to see the new historical high of the S&P 500. In this episode, I want to discuss the gold market picture, where it's going, how long it's gonna last, and what other metals you should have in your portfolio. And to draw the right conclusions before the price forecast, we're gonna review an interview with Michelle Meyer, a specialist in the US economy, which always sets new trends in the global arena. So get till the end, don't go away, and check if you're subscribed to the channel, especially our newcomers who just joined our community. Don't forget to turn on the notifications. Let's start. Since the 2018 fall, gold has soared by 70%, $850 to be precise. Why am I considering this period? Because this was the first time the US-China trade war issue got fraught, and the investors rushed to buy up the gold as a major defense asset. Why gold exactly? Because it already happened in 2007. Those who exchanged shares for precious metal bought it for $700 and in the end could earn a lot after the gold price reached $1,918 per ounce in 2011. So it's safe to say that muscle memory took over the investors. No offense here, of course. The most experienced players in the financial markets began to prepare for the crisis long before it took place and are now reaping the fruits of their actions. It's generally believed that the coronavirus was responsible for the market collapse, and that this crisis is entirely different, because we've only dealt with bankruptcies in various sectors before, not viruses. But if we put aside the virus and look at it as a catalyst for the market collapse, we can clearly see the crisis model. We can also find similarities between what happened from 2007 to 2011 and what's happening in 2020. The fact is, gold prices started to go up when we got the first signs of a financial crisis back in 2018, and the coronavirus was just a catalyst for a rapid fall. And if it weren't for it, something else would have happened. But during that crash, the gold dropped together with the stock market, just like it did in 2008. And then was the recovery phase, which lasted 3 years and allowed the gold prices to rise above 1,900. The Fed gave liquidity to the markets, but because of fear of a new fall, a massive part of it went into gold. Today the situation is exactly the same, except maybe that the markets got even more money this time. Therefore, obviously, Goldman Sachs expects gold prices to keep growing and name an approximate goal of $2,300 per ounce. Whether it's real or not, let's discuss in the final part of the video, and in the meantime, I'm gonna ask you for your like. And then I suggest we take a look at what's going on in the American economy, which is kinda a world guide. Today, as our expert, we have Michelle Meyer, the head of the United States Department of Economics at the Bank of America Merrill Lynch, which is, FYI, the investment division of the Bank of America that Warren Buffett loves so much. In her interview, Michelle Meyer said that the US economy has gone through 3 phases from her point of view. It starts with the quarantine and the catastrophic economic downturn. Then came the second transition phase, the recovery of enterprises and businesses, and the authorities' active financial incentives. As a result, we experienced rapid economic growth, and now it's time for phase number 3, which will be decisive to determine whether we can fully return to the pre-crisis level of the economy. Of course, it depends a lot on how the virus evolves, how people's money habits and preferences change, and how business adapts to new realities. Much now depends on the Fed's actions, and in the economists' view, they are doing the right thing. After all, Federal Reserve didn't just announce several economic support programs. It's launched more than a dozen of those, and it continually reviews and adapts the terms. That is, they look at what best helps the economy and enhance their efforts in that direction. The current cycle has shown that the Fed's steps to save the real economy are having a positive effect on the stock market. stock prices are going up, expecting that the authorities keep giving the money, and thus markets remain safe. And when people see new money entering the economy, they hope that markets will respond positively. As for the stock market or the real estate one, a bubble will be looming over them in the midterm. But Michelle Meyer is not too wary of it and believes that nothing will happen with the right monetary policy. Nor does she see the threat of hyperinflation, because the statistics now show a sharp demand decline, followed by a natural price decline. The US economy is far more threatened by deflation. She pointed out that the situation had begun to improve in recent months, but that was still too little to understand how to increase purchasing power to a sufficient level. The US public debt will keep growing at a record pace, but the economist sees no harm in it. There is no time to think about how to reduce debt. We gotta keep feeding the economy to overcome the crisis. Only when it operates again can we revisit this issue, and by that time mechanisms for debt relief will have been found already. On the other hand, corporate debt is also snowballing as companies are facing the choice of borrowing money or declaring bankruptcy. But what's important is that in the current environment, borrowed money is very cheap. That is, debts are enormous, but debt servicing costs a penny, and therefore it's not a threat. Households have similar conditions, but figures show that people are reluctant to accumulate debt at even minimal interest rates during the crisis. As a result, the growth rate of public debt is declining. What's really becoming a problem is the disappearance of the middle class, and not because they got ridiculously rich. On the contrary, many people are experiencing money problems. History shows that it's the middle class that creates businesses that drive the economy, and without it, it's impossible to achieve a state of prosperity. But the current trend in the US is that the gap between the poor and the rich is widening, and the middle class, which has been a deterrent to social tension, is getting poorer. So that was the insight and some observations that Michelle Meyer from the Bank of America shared with us. Let's try to draw our conclusions from everything we've had so far. And before that, I want to remind you that by pressing the subscribe button, you can not only support the channel, but become a part of the best community on YouTube. Thank you, and join now. So if we take our interview review, we can say that the Fed is not afraid to build up US public debt, nor it's afraid of inflation. So the money to support the economy will keep flowing, and the second wave of crisis is much in question. Now there are only two reasons why the stock market could collapse. One, we're gonna face the new stage of quarantine. Maybe the coronavirus will mutate, or nature will give humanity another unpleasant surprise for everything we've done to the planet. The second reason is a drastic change of the US policy, either before the election itself, as Donald Trump's last bargaining chip, or after the election in the event of his defeat. I'm probably more inclined to the option before the election, because I don't think the new president is gonna turn out a kamikaze wanting to finish the economy first thing. Therefore, Goldman Sachs' prediction of $2,300 per ounce may come true sooner than in 12 months. And if we imagine that the current crisis lasts a year or more, the $3,000 price might be more than real. For the gold to grow, investors must be 100% sure that the stock market is safe. But I've no idea what should happen for someone to believe that such a huge bubble wouldn't burst and grow for the next 5 or 10 years. And a little comment on the other metals. Bear in mind though, it's not a financial recommendation, it's just my point of view. Silver is now in the public eye, which is still far from the historical high, and it could easily grow by 50%, especially considering that silver follows movements of gold, which now seems too expensive for many people. However, I wouldn't be that optimistic about platinum and palladium that are back on the agenda. So platinum has been near its minimum values for the last 15 years, and it's not a good sign. Because forming a global upward trend is not an easy thing, and it's not enough that gold prices soared, and then again the current price may seem too high. The situation with palladium is quite the opposite. It's literally set the price record and is now in correlation. And there is a question here, can the market have a new high, or will have the bear trend from now on and the price will keep falling? It doesn't mean that palladium and platinum are a bad option to buy, but I realize that silver can make a big profit by following gold. Share your gold and silver prediction in the comments and join our community on YouTube. And that's it for today. Thank you for watching. It's the Coin Post channel. Subscribe and get enlightened.